T-bill on the dotted line, and then on the sort of hashed line, you've got the assets under management of Nigerian managed funds. And as you can see, they've been shooting up. And it really is a growth industry. And this is where at least some of that money is going. Investors are now getting into the managed funds. Just a few stats. First is that the volume of money held in fixed income funds rose by 59% in the first 6 months of this year. Volume of money held in money market funds rose by 11% in the first 6 months of this year. And actually the 3-year growth rates and 4-year growth rates are extremely good as well. And as you might expect, quite a lot of money has gone into dollar bond funds as well. What's happening on the regulatory side is also very interesting. The SEC is doing a massive amount of work to prepare the ground for the growth of the fund management industry. And this formed part of a very large document they put out in December of last year, and we all have to comply by the end of this month. So we're very busy doing that. Now, another point to make is that this is 1/10 the size of the pension funds, but it is growing fast. And the next thing to say is about the arrival of tech. And the point was made by the Director General of the SEC in the first address that we had, that there is a sort of middle-aged market, perhaps, of people going into the stock market or sort of individual accounts active in the stock market. Well, with tech, it's completely different. You're getting very young people who expect to get their money in and out of their fund in a matter of hours, to get confirms in hours, and they're very active, and it's a very competitive market because they're comparing a great deal across funds and what they offer, and this is completely different. So this is quite an exciting space to be in. Now, 1.1 trillion is not a huge amount of money, but look how the pension funds started. Pension funds started really quite small. Of course, it's a different system. It's a mandatory contribution system linked to full-time employment. However, they have grown to be in excess of 10 trillion naira. And then when people start talking about, the way forward and funding infrastructure in the whole country, they then start talking about pension funds because there's such a large amount of money held there, huge store of value. So this is how the pension funds have done, and I think the managed fund sector will replicate that over a 5 to 10 year period. However, things are never quite so easy. So one thing we've seen is a lot of money coming out of banks, bank deposits, a lot of liquidity in the market, and a lot of money heading into the T-bill market, where rates are extremely low, and also into the federal government of Nigeria bond market, and the rates have crashed. And the yield curve, which is in the graph on the left-hand side there, has really come down a great deal. Now, this is really interesting because if you can imagine a situation where rates stay low for a long time, then you're looking at a structural adjustment in the way that people save their money, and more money will go into funds, and it'll be there for a long term, and it'll be extremely interesting. However, you have to remember that a T-bill rate at less than 3%, in fact, I think the stock rate yesterday was 3.05% in the T-bill auction yesterday. A T-bill rate at 3.05% does not compare very well with 12.82% inflation. So you might see something else happen. You might see rates go back up. Now, if that happens, then they're mark-to-market losses on bonds, and that would be very interesting indeed, because people are taking risk. Now, they're not taking risk in the sense that the FGN won't pay them back. They're just taking mark-to-market risk in the bonds that they hold. Now, let's not forget it becomes a bit more complicated because most pension funds and banks have holdings of bonds that aren't marked to market, but nevertheless, there's a mark-to-market risk now. Now, if you compare this with my first slide, which was said that basically all you had to do for 10 years was put your money into the T-bill market and sit back and relax because that was going to get you 2.5% more than inflation, you now understand that we've moved into a different age. Interest rate risk management and actually all forms of risk management are very important now, like they were not for a long time. So this is going to be an interesting period for all of us as we have more money coming into our markets, but necessarily, I think more risk has to be managed. So what is the outcome of this? I think the outcome of this is really it's something that's been coming out through the conversation we've been having throughout the day. It's about guidance, and also it's about diversification. So I think that at the end of the day, investors who are going to succeed need to understand quite a lot of asset classes. And not just T-bills, bonds, and equities. And there's a lot out there, and almost sort of weekly you find a new fund or a new product being launched, whether that's a money market fund, fixed income, credit solutions, dollar bonds, equities, and increasingly private equity and venture capital. So again, there are more options, both for the retail, but also for the professional investor to invest in. Now, I have a background in equities, and so I'm going to end up with, I'm going to finish off this presentation with an equity market chart. And I know that equities have been, a pretty sour performer over the years, and despite the fact, and I would also distinguish that yes, we've had a great rally in the equity markets in April, but that's more of a trading gain. That's more sort of trading volatility than actually assessing the long-term risk in that market. So I wouldn't put too much emphasis upon that. But the equity market has not done well over the long term. It has not been a store of value. But it also comes back to what an earlier contributor to this conference said. He said that he had avoided the consumer-facing industrials and the consumers because he didn't think that, well, he think they were overpriced and he didn't see the growth coming through. And a lot of the long-term underperformance of the equity market has been those consumer-facing industrial stocks. There's food producers, there's brewers, there's fast-moving goods producers underperforming the market because actually they cease to grow. If you take that away, some of the equity returns actually look a bit better. And there are, as we say, pockets of value. And one sort of litmus test or one sort of benchmark that we use at Coronation Asset Management is try and look for companies with a long-term sustainable return of equity above about 20.5% or so, and start there. And it is, slightly alarming that you don't find many stocks that do that, but there are around 8 or so that achieve that over the long term. And so if you're diversifying, there are some equities that you can include in your asset allocation and your portfolio. So that's what I've really got. I think what we're moving into is a very interesting period. We've got a lot of money coming into the capital markets from the increasingly young people who use tech to get into their funds. You have a very demanding, well-informed audience and customer base who are very good with communicating with each other and who will learn fast. And I think we're going to go out into a period now of investing in a range of assets that are going to be interesting, and we're looking forward to the next year and the years beyond that. Thank you very much for this chance.
Thank you, Mr. Guy, for your very interesting presentation. Indeed, my takeaway is that there are opportunities for everyone, both retail and institutional investors, and there's a need to understand the various asset classes. Thank you very much. We will be moving on in this program to the next presentation from Mr. Niyi Adenubi. Niyi Adenubi is the Executive Director, Institutional Business and Investor Relations at VFD Group. Over to you, Mr. Adenubi. Thank you.
Thank you, Rolly, and good afternoon, everyone. And let me start by saying a big thank you to Business Day and to the Nigerian Stock Exchange for this invitation. I was given a very interesting topic, which is called New Perspective on Asset Allocation and Behavioral Finance in Volatile Markets. Rolly, I think you have the presentation. Are you presenting it?
Please go ahead.
Okay, so it's quite a long-winded topic, and it's quite maybe a complex topic for retail investors to understand. But my hero and my mentor is Warren Buffett, and one of the things that I admire most about him is in taking complex subjects and simplifying them. So basically, the concept is about what role does one's emotions play with how successful one can be in the market. And Warren Buffett had described this to say that if you have an average IQ, but with a good emotional discipline, over the long term, you can grow your capital and become very wealthy in using the markets. And I think that's very, very important. So basically, my slides just talk about how to stay disciplined, what biases to watch out for emotionally, and how to balance your portfolio so that over the long term, you can make money from investing. Another concept that is also important in behavioral finance and economics is a concept called the prospect theory by Daniel Kahneman, who won the Nobel Prize for Economics based on this theory, which also alludes to the same thing. When investors suffer losses or pain, it registers in their minds more than when they enjoy gains. So the simple concept in finance saying, or investment saying buy low and sell high becomes quite a very difficult thing to implement. Because of emotional biases, we tend to actually sell on the low and buy on the high, and thus create a frenzy which becomes an euphoria or a bubble. So to be able to make the move to buy the low markets and ride the wave and keep eternally, or sell at the high, it's a very simple concept, but it's incredibly difficult to implement. So I hope that after this brief 10-minute session, you'll be better placed to know how to manage your emotions when investing, or better still, just appointing the right managers. So thank you, Rolly. You can move to the next page. Yeah, so on the earlier page, the previous page, was a quote from Jim Chanos, who is a short seller who was responsible for bringing down Enron. And he said, I've learned there's a big difference between a long focused value investor and a good short seller. The difference is psychological. And I think it falls into the realm of behavioral finance, which is also to say the discipline to stay with your conviction, even when you seem wrong in the market, also has to do with one's emotions. So there are a couple of topics within the behavioral finance subject that I'll just mention on. They're a bit boring, but we can check them out later, so I won't want to spend too much time on them. But there's something we call the confirmation bias, which is validating the information that you already have about a particular stock or particular company or by a particular sector. So your brain or your mind will work in such a way that you process all the information that you have as if they were like the ultimate truth. And this would lead you to make sometimes wrong judgment. There's also a concept called anchoring. There's a recency bias. There's a familiarity bias, which is also a big one to talk about. Sometimes when you know a name of a company so well and it's so familiar with you, and you're, for example, trading, let's say a Netflix or Google or some of those names that you know every day, you can tend to make the mistake to use familiarity bias to invest in those companies. And like I mentioned earlier about Daniel Kahneman's prospect theory, there's a loss aversion. When you lose money or when you buy a stock and it goes down and you see that red, typically when you're choosing a company or an investment or a stock, you like it for a certain reason. So if you like it at the price, say 10 Naira, if it goes down to 9 Naira, logically, it means that there's better value for you in that stock and you should be able to buy at the 9 Naira. Psychologically though, once we start seeing that we've lost 10% on that 10 Naira, what typically triggers in our brain is to sell that stock because we don't like to see those losses. Meanwhile, the logic is telling us that if the fundamental analysis that we did to buy the stock at 10 Naira still exists, then at 9 Naira, it's even a better deal. Another major bias is overconfidence. When you've been successful, maybe over a period of time, or picking one or two stocks, you tend to believe or start believing your own hype, and it's very easy to make decisions without checking one's blind spots extremely well. So that can also happen. Next slide, please. Right, so this graph just speaks basically about what I've just spoken about just now, which is a period between 2006 and 2010 and how investors behave. I've already spoken about this, so we can move to the next one. Okay, so our approach at VFD Group through reasoning, through biases, right? So first and foremost is that we have a very robust investment committee at VFD Group. We have also independent members be a part of that committee. So even when one person is suffering from any of the things that I mentioned earlier, a bias, an aversion for loss, once you come into the room and you have a discussion, the outcome tends to be more rational and more likely to be right. The second thing is diversification. This requires some expertise. Too much diversification would ultimately lower your return in the market. And if you're over-concentrated, of course, the risk is very high and you could lose your capital permanently. I personally am not big on huge diversification, but if you handpick, I said 5 in my introduction earlier in the earlier message. My colleague or my friend who spoke from Coronation spoke about 8 stocks. I typically have about 5 that I'm interested in. In Nigeria, 2 or 3 of them are banks, then 2 telcos, and then sometimes you balance it out with 1 FMCG. And I'll just really focus on those things as opposed to looking at 20 stocks. And then we have a very defined investment policy that we follow. So it's quite restrictive, but it also introduces some discipline, which is very much needed when you're investing. Next slide, please. So I'll talk a little bit about portfolio rebalancing, especially in a volatile market, and especially also in a changing market. For example, I think over the last 3 years, anyone who's investing in the market would strategically need to start rebalancing the weighting of different sectors and different stocks in their portfolios. An example is telcos and technology companies. The trends that we're seeing now in the world is that this kind of companies will dominate business. Yeah, it's the fourth industrial revolution, and we expect them to be quite dominant in whatever sector they're playing in. Nigeria doesn't have, or the stock market doesn't have the fully tech companies, but in Nigeria, I would say the telco companies straddle the traditional businesses, but also incorporating some kind of technology into their business model. So I'd say that they as an asset, they as a sector pick, will start getting a larger portion of my portfolio vis-a-vis some of the stocks that one would have liked in the past, which are the industrial stocks. There's also a differentiation that's happening within the banks. The top tier banks are getting bigger and their returns are getting larger. The IRR and return on equity is outperforming their peers in the middle and the lower end of their market. So as opposed to maybe 5-6 years ago where you would want to buy all the bank stocks, today I'll pick only about 3 of them and manage my diversification that way. Next slide, please. When the CEO for the Nigerian Stock Exchange, Mr. Anyema, spoke earlier, he spoke about the ETF, the gold ETF, as an asset class that has enjoyed some good inflow in this period. I do agree that the market needs more depth and more asset classes on that platform. It's great that we have a gold index or ETF to track, but it also be good to have other commodities, either agricultural or hard commodities as well. So the gold ETF is very much welcome, but I think that the market needs other asset classes that can be invested in. Next, please. Yeah, so speaking of commodity investment, this is just a graph that shows the performance of gold and copper and cotton in the last year. Also, because of the currency crisis all around the world that's happening because each central government is printing money and quantitative easing so as to provide some kind of uplift or stimulant to their various economies. All investors and retail people across the world are no longer having a lot of confidence in currencies. For that reason, they're looking to hedge currency risks by investing in gold, silver, copper, and some are actually also using cryptocurrency, which has become very popular with a lot of investors. So I think that will be one of the major takeouts from this COVID volatility that we've seen. We've seen the US Federal Reserve pump more than 6 trillion into the economy. That would have an effect on the currency. And it's a no-brainer as to why we're seeing huge rises in the prices of gold and silver and the cryptocurrency. So next page, please. The challenges. So there are a lot of challenges in today's world. I think for the retail investors, picking the right asset manager or investment manager is your biggest challenge. I think you need to track very much the track record of those asset managers and do your research even on the personalities or the people that make up the investment committee or that are in charge of particular managers. I think it's very, very important that that's achieved. The second challenge, like I mentioned earlier also, is reallocating assets in a very difficult market. I think if you're an investor in this market, you need to start rebalancing your portfolio to reflect what I'll call the companies of the future, which are companies that have adopted technology as their core strategy to enhance whatever business offering that they have for you. I think now is also a great time to consider building a more robust portfolio based on long-term valuations. I think we're seeing some recovery in the market. We expect the foreign portfolio investors to come in at a later stage when there's a bit of clarity on the FX policies, and then the market will rally some more. So I would say that it's a good time to go in but you have to pick your stocks very carefully. So I'll close by just talking about our companies and our philosophy as a company at VFD Group. VFD Group is a proprietary investment company, and we have about 13 operating companies within the group. Out of the 13, we have about 4 or 5 that operate in the capital markets, asset management, stockbroking firm, issuing house, and we also have like an insurance brokerage firm. And what we're trying to do basically is to build a digital ecosystem where all our clients can come and have a one-stop shop, get the advice, get your investment managed for you, but also trade on the platform. And we also have a digital bank, which is VBank, which is the base on which everything sits. We're also big on activist investing and also acquisition of companies. We've made some plays in the capital markets, doing strategic acquisitions over the last 3 or 4 years. We acquired a significant stake in an insurance company, which we've since sold. And we'll continue to look for such opportunities that put us maybe in the proprietary investment, private equity model. We have a very clear and defined strategy, and we are looking to also list on the NSE in 2022. In preparation for our listing, we've set up an investor relations function that's quite active. We're one of the first people or companies to have a virtual AGM at the onset of COVID-19 pandemic, I think in May. We have frequent calls for our investor calls quarterly, and we have a very accessible investor relations desk as well. So thank you very much. That's my presentation. We can go on to the panel now. Thank you.
Thank you very much, Mr. Adenubi, for that engaging presentation. We will now be moving on to the second panel session for the day. The panel session is themed, Is it all in the mind? Interpretations and perceptions of market events against performance. I would like to, at this point, introduce Mrs. Tosin Ajose, who will be moderating this panel. Tosin Ajose is the lead advisor of Deal HQ Partners. Over to you, Tosin.
Good afternoon, everyone. I'm just going to wait a moment for my video to come up on the screen, and then I'll start the conversations. Okay, yeah, good afternoon, everyone. My name is Tosin Ajose, as I was earlier introduced. This is the last session of the day, and we are almost completely out of time, but we will do our best to ensure that, we engage in very interesting conversations in the about 45 to 50 minutes that we've been given. Without wasting more time, I'll just go ahead and introduce the panelists who are going to be joining me in this conversation this afternoon. I have on this panel Lillian Olubi. Lillian is the CEO of EFG Hermes Nigeria Limited. We also have with us Niyi Adenubi. Niyi has just rounded up a quick presentation. He's the Executive Director, Investor Business and Investor Relations, VFD Group. And finally, but definitely not the least, we have Bumi Ashaolu. Bumi is the Head Equities, FBN Quest Senior, FBN Quest Nigeria. Apologies. Right. So what we are going to be discussing today is actually attempting to dimension investor psychology and investor behavior, understanding the things that typically underlie decision making when attempting to make investments in the capital market. So without further ado, I will just go on ahead and start with the questions. Let me remind the participants that we will take about 5 minutes to answer questions from the participants. So if you do have a question from this panel, please send through on the chat function on whatever platform that you're working from. We'll do our best to accommodate as many questions as we possibly can before we have to wrap up the session. So I'd like to start by focusing on market performance and the psychology of investors. A lot of people have alluded to the fact that investor psychology is not necessarily always consistent with facts, data, or underlying market fundamentals. And permit me to quote the words of Sir John Templeton, who's the founder of the US-based asset management firm Templeton Investment, who says that bull markets are typically born in the time of pessimism. It grows on skepticism and matures with optimism and finally dies on euphoria. These are some of the different levels of sentiments that happens in the market. And I know that many of us have seen the Nigerian capital market go through several of these different stages of emotion and turn different cycles even at these different stages. So my first question, which I would allow each one of the panelists to respond to, will be, right now we see that the market is about to make a turn, and we are seeing a lot of interesting turn at this time. So I'd like to know whether we feel that as the market is approaching a new turn of a fresh cycle, are we expecting that having been, having had, a lot of downtime in the market, are we expecting, investors to enter into, a wave of reckless optimism at the first, sign of recovery? Or do we think that they are going to go through, the whole cycles of pessimism and maybe subsequently skepticism before the market eventually makes a full turn? I'll start with Lillian and then possibly go to Nii and then Bumi. Lillian, over to you. I think you need to unmute your microphone.
Yes. Thank you very much. Thank you. Thank you, Tosin, and thank you, Nii, for that insightful presentation, which I think lays a very good foundation for this session.
Thank you, Lillian.
Approaching a fresh cycle. Tosin, my easy answer will be, I don't think so. And this is why I say so, because it is true that markets are, cyclical in nature, and often we see these cycles that return, following very long periods of suppressed valuations, which is the situation we have now on the equity. But irrespective of the psychological responses which you mentioned and are true, they're often, triggers, I think, that sort of must follow these things. And if you remember from the session before ours, where the MD of CSCS mentioned the things that have happened in the economy before these cycles were precipitated, you will find that we're not there. And so firstly, I think the first challenge for me is that we are in very unprecedented times. And I think in many ways, many things are still unfolding in terms of the lagging effect on the real sector, on businesses, on households, and even the listed companies. And so we haven't seen the full scale and extent of what we're dealing with. Secondly, and maybe more importantly, is that the marginal investors in the market are the foreign investors, irrespective of the trade splits that the NSE produces, which is local versus foreign, putting locals at 60%. I think based on the way that the foreigners trade, they're the influencers of price. And it's an open secret that this segment, who have exited most other frontier and emerging markets, have been forced to remain in this market, due to the currency and repatriation challenges that we've been having, and have chosen to reinvest their funds, instead of leaving them dormant on the queue, waiting for the foreign exchange. And for this group, confidence, liquidity are very key issues. Liquid currency, markets are very key factors to their comfort. So I think it begs the question that when they leave, what happens? Now, fine, we shouldn't have total reliance on this group. But when you look at what we have now as the local market emerges, you ask yourself, when you look at the local institutional space with the institutional and retail clients, you ask yourself whether it's enough to move the market. So you have PFAs who have less than 5% of their portfolios in equities. You have the retail segment who are mostly followers, for want of a better word. You sort of go through the head mentality issue and are not self-analytical in and of themselves. So I think this will pose a challenge for now, and it will take a very compelling macroeconomic story for us to see an alteration in the dynamics or see, let's say, a new cycle emerge. You also remember on the last boom that we had, there was a confluence of liquidity, of issuances, of many other things, and macro environments that supported that. Right now, the macroeconomic environment do not support this. So there's a lot of ongoing initiatives and policies we're hoping to see that will drive change, but I don't think they will be immediate. So my take is that it's going to be beyond just the first sign of recovery. I think, we would have to see very strong and sustained signs of recovery before we can talk about a reckless optimism, as you put it, Tosin. So that's my view. I don't see that cycle emerging right about now.
Okay, thank you. Nii, I'd like to hear your take, but I'd also like to know, from your own perspective, because it looks like there's still, somewhat of a lot of activities happening in the private equity space. I mean, at this time, even though, the economy is stifling and a lot of, things, that we are not seeing, that many activities in the capital market. So what do you think we would see in the mid to long term, in the market, just, in line with the earlier question? Do you think that, private equity would have an upper hand with investors at this time, or do you?
Okay, that's an interesting dimensioning that's a very good, interesting dimensioning people pattern happening necessarily quite soon. Also because we don't know how the economy globally shapes out with a post-COVID world. Also, the last two recessions that we've had in Nigeria, especially the major bust after the 2008-2009 bust, has most people. However, I do have some hope that younger people, 2008 and 9, and through new technologies that are available, will be the savior of this market. So I expect more day trading, more sophistication in terms of algorithm, maybe over the next few years. But I think that we're still maybe a while away. The other question about private capital making a significant play in investing in equities. I think that's been the trend globally. I saw a report last week that showed that the number of companies that have gone to the market to raise capital compared to the 90s has gone down by about 60%. So typically in the 90s, once you have an idea, after about 3-4 years, you go to the capital markets, you do a listing, an IPO, and you raise money. Now, most companies prefer to also go private, which is quite unfortunate because only institutional guys can participate in the private market, which is private equity. And that also adds to wealth being created for only a segment of people and not being shared across board. So I hope in Nigeria, we're able to introduce policies and encourage companies to list. I've been championing like the listing of MTN and Airtel and the other telco companies for some time. So I'm glad that happened. But the Nigerian Stock Exchange plus the SEC and the government need to be deliberate about encouraging companies to list on the stock exchange and make it also easy to list and easy to stay on there, because there's a lot of private equity money that's available. And sometimes it's just always easier to have one principal than to be a public company regulated by many.
Thank you. Thank you, Nii. Bumi, I'm sure you'd like to say one or two things to add to that, what has already been said about the question.
Thanks, Tosin. Good afternoon. And also to say thank you to Business Day and the NSC for organizing this. Yeah, much has been said about this question. I'd add my 2 pence worth. I think, first of all, it's hard to say or to predict that a fresh cycle or recovery rally is on its way. Not because I'm saying that there isn't one. I'm just saying it's very hard to predict one. For Nigeria specifically, for any of this to happen, it has to be macro-led. And I use the word macro very loosely. I just mean anything that is beyond the market, essentially. So whether it's all recovery or some sort of stability on FX or some mega reform that people are really excited about, it is easy to point out the reasons why investors, whether they're local or offshore, wouldn't participate in the market. But you'd be surprised that if one thing goes well and people are quite impressed by it, it could easily change the sentiment that people have about the market. So if you remember when the NAFEX window first came up, there was a lot of uncertainty and questions as to whether it would actually work properly. And at some point, everybody realized that actually it solved a problem. Maybe it wasn't perfect, but it solved the problem. And that helped a little bit. And eventually that snowballed into people having a bit more confidence in the markets, which helped both equities and the bond market at that time. So if indeed we get a catalyst, I don't know what that would look like, I would say that it is very possible to get a rally kickstarted just because of the way investor psychology sentiment can go. I mean, you only have to look at the US market to see how this can play out. So in Nigeria specifically, valuations are very depressed, and that will give some people a reason to say, actually, something that I was complaining about has been taken out by this catalyst. Therefore, I'm happy to get involved. Because the valuations are so depressed, any decent gains you get will spur on other people. And at some point, you may get both the so-called sophisticated investors as well as the non-sophisticated investors doing exactly the same thing, which may ultimately lead to some reckless optimism, as you put it, as that phrase. But I think, first of all, the major issues have to be resolved first, even if it's just one modest improvement in whether it's liquidity, whether it's FX reform, whether it's some other reform that people are excited about. And to finish, I think this word cycle, I think one has to be very careful about this, because if you get a monster rally, investors will be very happy, even if it's not a proper cycle. So I think we're just waiting on something that is going to be positive, whether GDP growth or FX, that will give people a bit more lift to lift their heads up.
All right. While we are still hoping on that positive trigger that would take us, to a point where we can agree that the market is actually in recovery. A lot was said, in the course of the conference about the psychology of foreign investors, specifically from Eric's presentation. He alluded to, a number of things around how foreign investors typically look at our market. And one of the things I took away from his presentation was that we should look to build the Nigerian capital market via local investors in the first instance. So I'm going to be asking, this question is specifically directed to Lillian. So in trying to dimension the psychology of local investors, would you say that there is sufficient data to guide investment choices across, the investor demography? And how mature would you say our local investor demography is at this time? And what do you hope to see the stakeholders in the market, like the brokers and the Nigerian Stock Exchange, and even issuers of securities? What would you like to see them do in terms of, investor information and engagement? What are your thoughts?
Thank you, Tosin. A few questions there. So on whether there is sufficient data, broadly speaking, there's quite a lot of data between the websites of the exchanges, between these newswire companies. There's quite a lot been, and of course the regulation that enforces information. I think the question is, do we have enough savvy retail investors to access or comprehend the information that is being put there? Or is the information disseminated in the form that is needed by them? And it's another question which, hopefully we'll get to. Secondly, you ask how mature the demographic is. First of all, it's the demographic of the retail investors is quite small. And we heard again from the previous panel, the number of active clients this year in the retail space. But within that segment, there are actually different segments and different types of retail investors. And even though I work with a company now that's predominantly institutional based, I've had most of my career dealing with retail, the retail segment. And so I have, a fair sense of how that plays. And so you have a lot of those people who are, a few of them who are very active, quite sophisticated. These are your mid-level senior executives who are playing the market very intelligently, generating some, alpha to their personal and group portfolios, because these days a lot of them are investing in baskets. And you see some of that effect in some of the companies that are very focused on online platform retail. Then you have another subset of investors who are very docile, very inactive, and they're the ones that usually just sort of follow and they jump in the bandwagon when there's change and where they see somewhat of a change in the market and things like that. And then, of course, you have somewhat of a growing retail millennial that has access to data. They have a form of savviness, I like to say. But when you look a little deeper, you find that they also do not know much about the markets. And there's a way also that they interpret and how they are influenced by their decisions. And so those are the issues. Of course, with the inactive, we saw what happened with the 2007-6 bubble, and the way that the retail investors jumped in with very minimal information. And you see why the effort now with the regulators is to try and concentrate them toward managed funds and have them be in these baskets where they do not have the responsibility or burden of making the choices themselves. So lastly, on the efforts, or rather before lastly, on the efforts with the brokers, the regulators, issuers, the regulators have done, or are doing, I should say, phenomenal work. We're trying to improve financial literacy drive across, different segments of that pot. And we see, of course, with the NSE disseminating information in very simplistic ways. And if you look at the NSE website, you see they created this magazine just to break things down for these investors. We see the SEC, who has a financial literacy committee on the capital markets committee, doing a lot of work with schools. I hear there's now a financial literacy curriculum added to the curriculum in some secondary schools. And it's undoubted the amount of push. The question again for me is, are we measuring the impact and are we addressing the approach of this financial literacy drive? And you mentioned an important group about the issuers, and I don't think that segment is doing enough to sustain that drive. And so what we find now with the issuers is that most of them concentrate on the institutional client base, and you see them often do some road shows. You see them have these client calls and meetings to address and facts behind the figures. But you're not seeing them, I'm not seeing them focus a lot of effort on the retail segment, and I think it's an interesting thought that we might actually be missing out of. And so we need to direct some effort there. And I think it brings a very useful opportunity in the information drive for corporates to begin to consider selling their stories in a simplified way, to garner that subset. There are lots of companies now, and I'm not sure I have the permission to list them, that are doing phenomenally well, that need to tell their stories, not just to the corporates who are already in, but to these other segments that we're not looking at together, especially the millennials who are ready to look for, or are more open, I should say, to some risks. And so apart from that, of course, I think also collaboration between all these agencies, i.e. these fancy companies, news companies that are putting out good information, these issuers and the regulators, and alongside with the brokers, I think that collaboration would do a lot more to make sure that the targets and the import of what we're trying to do with this drive is achieved.
Thank you, Lillian. I think it's very interesting, that you note the fact that a lot of times the retail, segment of the market is not much attention is being paid to that segment of the market. And I want to also mention that even some of the information that goes around, even after making the investment to shareholders and unit holders in some of these funds, I think that simplifying, for instance, your annual reports and those documents that you typically circulate to investors could actually be very helpful. A lot of the institutionals have people whose job it is to actually dimension, understand, and advise on the impacts, or the facts behind the numbers. But many of the retail investors can't really do that. They measure performance simply by returns, which is, not necessarily always, perhaps the right way, you know, to look at.
And to mention, Tosin, that is the way, that is the new tomorrow. That is the area we need to concentrate on. We're literally the most stable and sustainable group subset that, you know, should be major players in the market. So we don't have a choice. We need to focus on that group and make sure it works. So sooner the better.
I'd just like to add just a couple of points here. So Lillian, I think that's a fantastic point that you made. And I think I also was alluding to that earlier when I mentioned that the future of the market depends on the younger people today, which is mostly retail and also technology. For us at BFT Group, we actually grew on the back of retail investors. So our initial attempt to go straight to institutional didn't work out. And so we reverted to small investors. And it was small money, 100,000 naira, 200,000, 1 million for a long time in a private company. And we found and we learned through that process that even people that are not savvy or interested in business or finance, they want to save money and they want to invest money. So if you can devise a process to carry them along well, they will support you through your whole journey. And now we're a public company, PLC, and obviously for that reason, also moving a bit institutional, but it's also very core to our strategy that we never lose that retail connection, because we also do believe that it's the future of investments.
Thank you, Nii. So let's go and talk about hype in the market. I mean, apart from, you know, fundamentals, there are other things, you know, other, you know, nuances that, you know, shape investor behavior. So, I mean, some people believe that it's more sentiments than fundamentals. Some other people believe perhaps it's more, you know, fundamentals than sentiments. But let's understand when we talk about sentiments. So people talk about hype in the market. So if we say that investor behavior is sometimes driven by sentiments, Nii, would you want to tell us how you think that, you know, sometimes these sentiments are formed? Is it actively propagated by the media or by analysts or digital marketing platforms? And do you think that issuers actively develop a hype strategy to sometimes influence the performance or pricing of their securities on the capital market?
This is a very tricky question, and I will try not to get in trouble.
Please don't get in trouble, but please tell us what you honestly think.
I think like everything else in life, I think there are good actors and there are bad actors. I think that companies need to tell their stories so that the investing public can understand it and make decisions as to whether they want to be in those companies or not. Drawing the line between calling it a hype or, you know, a false sentiment is very difficult for me to say. But I think that historically, if you've studied the markets, we've seen all kinds of actors. We've seen people deliberately hype a particular stock and it rises to a crazy euphoria. I think in the global markets today, there's a stock this year that has risen, I think, about 300%. And it's fair to say that the chief promoters of the company are also encouraging the behavior. So they can see the hype there. You can see, I think the SEC has tried to sanction the company about 2 or 3 times. So there's a deliberate effort to do that. However, I still also think that the media, the promoters of the company, that collaboration, it's all very necessary to give enough information and create some kind of buzz for people to be excited about a company or a sector or by a particular market. But where you draw the line as to where you cross over can be quite difficult to say.
Okay, Bumi, I just want to know what you think. I don't want Nii to be the only one getting in trouble, just in case he does.
Yes, share this with me, Bumi, please.
I mean, what do you think about this hype? Who's responsible? How does it, you know, impact the market? And do you think issuers deliberately, you know, develop a strategy to hype their securities in the market?
Well, first of all, I'll say that this is not, if this exists, which it probably does, it's not a Nigerian issue, right? It's not a Nigerian only issue. That's why you have regulators, whether it's in Nigeria or elsewhere. I think if you are not careful, whether you're an issuer or a newspaper or an exchange or whatever, there's a propensity to slide down this risky slope of wanting to promote something because you want things to be better. So if you own assets or you own a stock, or if you're an investor relations person or you're CFO of a company, obviously, if your stock does better, then you will probably find that your package, your compensation will be linked. So there's a risk that if stakeholders don't watch themselves very carefully, that you find that you would end up doing things that you would, in theory, not expect yourself to be doing. So I wouldn't say that one person is responsible for propagating practices that are not befitting of what you expect in the capital market. It's just something that's part of human nature, and everybody just needs to be aware of it and really put policies in place that would prevent the worst side of us human beings from coming out. So I don't think it's one particular group responsible for any of these.
Yeah, Tosin.
Okay.
I would like to just add also that besides trying to control it from a regulatory perspective, which can work and is usually effective, I'm a big believer in markets. So markets function, they always function. And in this case is to grow in like a case like Nigeria, where we haven't grown a shorting market. If you promote a company illogically just because you're hyping in just to get a fair price, if there's a considerable shorting market in that system, you would be, it would happen that professional people who are shorting the market will pick up the noise very quickly and will start to make the moves to counter that hype. And through that back and forth, that would reduce the number of bad behaviors that you can find in the market. So the regulators can try to do as they're doing, it's effective, but ultimately we should look for a way to find a market solution, and having a good shorting or ability to short a stock would be fantastic.
Okay, I mean, just before we leave that point, I just wanted to, make a reference to the fact that there is a lot of, promotional activity that actually goes on the on social media and what have you, and a lot of, companies that play in the capital market do a lot of things around, that space. There are a lot of, subtle ways that, people promote, the activities of their organizations and sometimes even their securities. I mean, I just wonder whether the regulators actually catch on some of this information that is subtly disseminated across, some of these platforms. It's not a question. It's just an interesting thing that I wonder whether, whether anyone is checking or looking at. I'd like us to quickly touch on the role of technology in bridging the gap. I know that, when the Nigerian Stock Exchange CEO was speaking earlier, he alluded to some of the major milestones that the Nigerian Stock Exchange was able to accomplish, during the period of the lockdown and even subsequently during this period of pandemic. And he alluded to the fact that they were able to transition fully to their virtual trading platform. And I also know that they were able to do this quite seamlessly. So, I mean, this could suggest that technology might very well be a defining factor for developing, the Nigerian capital market. And so I'd like to ask Bumi, how do you think that we can use technology to drive efficient investor education and engagement?
Thanks, Tosin. So I think the first thing I'll say is investor education in general, should be part of life for every investor. It shouldn't be an add-on. It should just be, like BAU. It should just be normal. But up until I think this crisis hit, you would find a million reasons why people would give reasons, whether they're invalid or valid, or excuses for not adopting technology as much as they should have. And I think this goes across, I don't want to say everyone, but most people, investor groups, organizations, whether it's even private, public sector, we've all been a bit slow to some extent with the pandemic, I mean, even this conference that we're having, suddenly it's supposed to be perfectly okay. So I think it's when you see some of these really extreme scenarios happen that we suddenly realize actually some things should have been tested properly before, and it's okay. So I think the first thing I would say is opportunities for engagement like we're having today between investors, market participants should be made available and to be broadly accessible. And all parties need to come together, NSC, media, sell side, buy side, all the communities should be working together to promote engagement forums like this. And the second is maybe a charge to the private sector to do better with the enabling of online access for the retail investors in particular, and not just for trading, but actually to engage. Because it's one thing to learn, to use technology very well, but you don't want to be stuck in manual or analog when it comes to the actual trading execution experience. So I mean, this should apply from your onboarding all the way to your trading. I mean, CEO of NSC was referring earlier to remote trading and how the exchange has facilitated a very smooth working environment. We've all had to, right? I'll just encourage, I think, all parties to continue to push to be able to get the investors much closer to this market, because up until now, we will always find reasons why maybe it's a capital injection, investments that we need to make that are significant. But when the pandemic hit, nobody was saying, oh, actually, it's going to cost too much. For this market to really move in leaps and bounds, getting investors to be able to engage properly and then obviously, trade with technologies is a big, big, big requirement.
Lillian, I just, really still talking about this stakeholder engagement and looking at the market, as a larger framework. A lot of conversations have been had since the pandemic about, also ensuring that we are able to optimize, the experience with the government side of things. And so I'm going to ask, what you think about, being able to enhance, the capacity of the regulators, with technology. The moment to, touch on this. What kinds of technology innovations would you be expecting to see from, the stakeholders other than the market itself, like maybe the SEC or perhaps the central bank in terms of, derivatives trade and fixed income and the rest of it? What kinds of innovation do you think will support, this the drive of the markets, from their end?
Okay. Thank you, Tosin. So, as I said, technology is everything. And if we didn't know that, I think this pandemic has shown us very clearly how the world moves with technology. And I think that the data speaks for themselves. So if you're talking about, they say almost, I think, 85 million mobile internet users in Nigeria, 27 of these active on social media. When you ask the question, what can the regulators do? I think it is obvious that we need to be in that space, to be where the people are through technology. So it's a big pool of potential investors when you look at those numbers of people who are on their phones, and you also look at the data of the number of times those subsets are using social media actively in the day. And so it is to divert some attention to our tabs, to our handheld devices, apart from the less traditional ways that we have hitherto sold. I think the NSC and the regulators have done, I don't see any gaps in terms of the technological infrastructure that's already in place with the stock exchange. They look ready to scale from a derivative standpoint, from a increase of asset class standpoint. They have state-of-the-art technology that's ready for that. And it was nice to see, as Bumi had already alluded, to see the transition that happened even when the lockdown started, with the seamless nature in which 200 and something brokers were able to transition very easily to trade remotely without any issue to date, which just sort of evidences what had been put in place and even for the future asset classes that they need. And so again, it's to coordinate efforts, right? So it's to collaborate, perhaps the regulators and these stakeholders with these guys who are tech savvy, with the financial journalists who are using technology to pass on messages. There's several of them that we know of. And so let's not also forget, of course, that technology is an amplifier of volatility, which is created by greed and fear. So we see those, but it's a healthy way to go. We have no choice, and I think the markets are ready for that. But it obviously has the power to transmit market contagion very quickly, and it's how markets grow. And so there's no way around it. I think it's really about the regulators and these subsets meeting the people where they are through our devices. I think it's the first step.
Thank you. I'll quickly ask a question around data and data analytics, but I do hope that the organizers will give us some additional 5 to 10 minutes for this panel session, given that we actually started, slightly late. Please let me know whether we can stretch just a little bit so that I'm sure we can take all the questions that we have. So, Nii, I'd like us to talk a bit about data. And I know that, the market fundamentals are typically driven by, access to data. So my question will be, will the use of technology for data collection and analytics possibly eliminate human influence in investor decision making and just generally trying to, analyze the market? How much of data would you say is available? I mean, for the different demography, institutional investors, retail investors, and even HNIs. Are we at parallels with other markets, or do we have more work to do in terms of just ensuring that there's sufficient repository functions going on? I remember that I think Jallo had mentioned in his presentation that they do a lot of data collection at the CSCS and make this information available. I don't know whether that availability extends to retail investors, but what are your thoughts in terms of data availability, one, and the use of data analytics to actually take investment decisions?
Okay, thank you, Tosin. This is also a very, very, very interesting concept that we're dealing with in the world today. So we're just talking about technology, which is a game changer. But with the technology, the data is now everything. You asked if we're at par with the rest of the world. The simple answer is that no, we're not. I think some of these other sophisticated...
Kindly let's keep your answer to 2 minutes. I'm being prompted that we actually do need to wrap up. Let's keep the answer to 2 minutes so that we can take at least 1 or 2 questions.
All right, no problem.
Thank you.
Yeah, so there's no question that there's still a huge gap in terms of our data readiness and using data an algorithm ultimately to be able to predict markets and possibly eliminate, perhaps not, but reduce the human interference in the markets. In more sophisticated markets, I think they've gone extremely far. In our markets, not so much. The technology that's set up and data acquisition will continue to improve that. I'll give it 5 years. I think that we will also be quite sophisticated in the Nigerian capital market space, using data and technology to predict the markets. But if I'm to keep the answer short, yes, it's a game changer. It's a new world. We're seeing fat fingers type trades these days. We're seeing trades being analyzed and executed in seconds or nanoseconds. We can see trends being analyzed in nanoseconds. So the edge is for how powerful your tech and your systems are and how quickly they can accumulate and read the data and then make decisions. That's the trend in which we're going in the world. So definitely the data is a game changer also.
Thank you very much, Nii. I've been told that we can actually have about an additional 7 minutes. I'll try to optimize the use of these 7 minutes. So let's talk about the journey to recovery. I'll take just 2 questions and then we will move the conversation to the audience. So in the face of dwindling economic performance and most recently a lot of heightened business insolvency risk, shrinking foreign reserves, like a lot of people have mentioned in the course of the conversation, decline in productivity, falling consumption rates. The capital market generally has not been insulated from this general, economic performance in the market. And at this very uniquely challenging time, both the public and the private sector will be looking to the capital markets to meet their funding needs for operational funding, for recovery, and for growth. So my question, which is first of all directed to Bumi, is will the capital market be able to deliver sustainable long-term capital that will set the real sector on the path to recovery? I'm hoping your answer is yes. And if it is yes, how long before we start seeing, some of these positive, changes and actual delivery of capital needs to real sector?
Okay, I'll give you a nuanced answer. So in theory, yes. The question is, will it? Honestly, it's too soon to tell because there's much riding on one thing, which is really confidence. If we get some sort of improvement, again, at this sort of micro level, whether it's through luck or design, trickles down, encouraging all parties to have more confidence in each other and the markets. And there is ample capital. It's just that it's either very difficult to part with by those that have it because they would rather give it to entities that they trust will give them a decent return on it, right? ECM, equity capital raising, hasn't been as vibrant as would like, especially when you compare it with the debt markets, which has broadened out beyond domestic to hard currency, even commercial paper. But it would be great even if those ones you see longer terms on them in terms of how many years maturity, or if the number of companies that can access those markets are broadened out, because right now there's too much narrowing. So I think private sector pushing the boundaries to create more products. We see that, you see a lot of that happening, but what you tend to find is that the pushback or why these things don't get done, or why there's not enough buy-in, is because there's a lack of confidence, whether it's from the regulator, whether it's from the investors. So that word confidence, I think, is the thing that needs to work out. The largest pool in this country is the pension industry, right? For capital funds. If there is a bit more encouragement that can be brought in to incentivize diversification beyond risk-free assets, if you think long-term, there has to be some sort of balance between just keeping the money super safe and meeting the future obligations, because right now there's a big gap that's growing between the obligations that need to be funded and the returns that you're currently getting on these assets. So I think a bit of shift is required just in the way all participants sort of get together when it comes to capital raising in markets in general to boost confidence. And I think if those things align, then the answer to the question will be a bigger sort of capital letters yes.
Okay, thank you very much, Bumi. I'd go quickly to Nii. I've seen a lot of comments coming in about the foreign exchange regime and FX crisis and all of that, and I just want us to touch on this in a minute or two. So one of the major sources of foreign exchange is FPI, foreign portfolio investment, coming into the country. Listening to Eric earlier, I think that we know that there isn't a lot happening in terms of inflow of foreign capital. So Nii, what do you think the market can do? So I know that we need to develop, local, our markets using local funds, but we have, significant reliance on foreign exchange, even from the real sector. And at this time, even if we wanted to fix that, it's not going to happen in a year or two. So what can we do to ensure that the capital market is also able to have a fair share of foreign exchange inflow that can possibly ease, the current tension that we have in terms of, the foreign exchange markets at this time? Please, 2 minutes, if you may.
Okay. Thank you, Tosin. So I think that regardless of how good we might be with our economic structuring, I think that for all frontier and emerging markets, they need foreign direct investment and foreign portfolio investment. You just absolutely need it. You can't shut it off. And if you're arrogant to shut it off, then you're going to be in major trouble. So at the beginning of this program today, I was very surprised because when I was thinking about this question, I was thinking that I'll encourage the NSC to work closer with the central bank, the Apex Bank, to formulate policies that will make it easy for foreign investors to move their money and just have very good, effective FX policies. So I was very surprised when he himself asked for a more collaborative CBN. I was stunned, which means that it's unbelievable. So as part of not getting into trouble today, I will just leave it at that. But it was quite surprising.
I was just going to remind you.
I'm still very conscious. So it was very surprising when he said that. But I'll just say that I do hope that all the regulators find a way to collaborate better so that they can formulate policies that benefit the entire economy at large. We had issues with some companies that listed through a GDR to be able to pay their dividends in dollars. It was not very encouraging. A lot of people sold their naira-denominated assets and they couldn't move their money. It's not very encouraging. So I think that what he asked for is also what I'll say. We need to find a way to resolve and unify FX policies and also encourage a diversification from crude, even if it's still natural resources. There's gold, there's very many other things that they're trying to encourage now that can bring in inflow of foreign currency. But it's just absolutely crucial. I think the most fundamental thing that we face over the next couple of years is how we manage our FX policy, to be honest. So.
Thank you very much. At this point, I'll just take one question from the audience. I have one more question to ask Lillian on equities. I do hope that we'll be able to take that, but let me just go to this question quickly. I don't have a name here, but the question says, considering year-on-year inflation compared with expected returns on investment in local stocks, is it really advisable to invest in securities on the stock exchange? This is from Iduku Lawson. Okay, there is a name. I think I'll direct the question to Lillian.
Thank you, Tosin. So it's very interesting that there's aversion to the market for the same reason of negative real return. But when you look at it in the long term, this is the market that you want to be in to beat inflation, and the numbers speak for themselves. And so it's a very interesting space that we're in. And you find local institutions who are out of equities because they need safety. They're dealing, and there's a distortion there because they ideally should be, taking care of pensioners with a long-term view, but they're challenged. You have the people who are also following that standpoint. But the reality is that, the stock market is the long-term market, and it's a market that beats inflation and meets that need. So you don't see the immediate effect like you see with the fixed income, your low rates and your high inflation rates, and obvious negative returns. With the capital markets, and the numbers speak for themselves, over the years has proven to be a more efficient market to be in to solve that problem. But unfortunately, I guess we all have near-term incentives that we need to take care of that make that a challenge. And I hope that can be fixed sometime.
Okay, thank you. We are now completely out of time, but it's been a very interesting panel session, even if I have to say that myself. I'd like to first of all thank all our attendees who have joined us and have stayed from the beginning till this time. Thank you very much. Thank you to Business Day and the Nigerian Stock Exchange for putting this together. And the biggest thank you goes to my panelists. Thank you so very much for making the time to be here. Thank you, Niyi. Thank you, Bumi. Thank you, Lillian. And I would at this point immediately hand back, the session to Rolly of Business Day. Thank you very much, everyone, for joining us, and have a very good afternoon.
Thank you, Tosin, and thank you, Business Day and NSA. It's been fun. Thank you.
Thank you, Tosin. Thank you to our esteemed speakers for sharing your wealth of knowledge on that interesting panel discussion. Mrs. Lillian Olubi, CEO, EFG Hermes, Mr. Niyi Adenubi, Executive Director at VFD Group, and Mr. Bumi Ashaolu, Head Equities at FBN Quest. Thank you so much. We will now, at this point, be going to take the results of the polls that were shared earlier. The polls are being displayed on your screen, and quickly, the questions that were asked. The first question was, will the recent shock reforms of electric tariff, VAT increase, and petrol subsidy removal, will it be a net benefit for the Nigerians? 52% of respondents said yes, while 48% said no. For the second question, the growth sector window on the Nigerian Stock Exchange was conceived to target SMEs for listing. What factors have held back the SME IPOs? 38% said few stories of sustained successes of SMEs on the NSE. 28% went for cumbersome reporting requirements, while 17% each alluded to fear of loss of control and illiquidity of penny stocks. Thank you. And at this point, we will be taking a brief advert from our sponsors, and we will be coming back with the closing remarks of the MD, Dr. Ogo Okiti. Thank you. Welcome back, Dr. Okiti.
Rolly, thank you so very much, and thank you for moderating the transitions since 10 a.m. So my name is Okiti, and I am the Managing Director of Business Day Nigeria. And you have been watching the Business Day Investment and Capital Market Conference 2020. For me, personally, it's been very, very insightful, very engaging, and quite a lot to take in. So the presentations have been awesome, and the conversations have been quite revealing, I must say. So the 4 hours that we have had has just gone so very, very quickly. So I thank you all. First, let me thank all our speakers, because they have not only shared their time with us this morning and afternoon, but they have also shared their knowledge, their insight, and their wisdom on the capital market in Nigeria. So I thank all our speakers. That's including the leadership of the Security and Exchange Commission. That's Lamido Yuguda, the Director General. We thank you, sir. And the leadership of the Nigerian Stock Exchange also, that's Oscar Onyema. We thank you for your time and for your insight during this conference. So many other speakers, Eric Renada, Aruna Jalo Waziri, Omobolanle Adekoya, Unamdi Nwizu, Ete Hogo, Uche Obi, Kaz Toski, who is of Coronation Asset Management. We have Tosin Hajose, Linear Lubi, Bumi Asaolu, Niya Donbi, and of course, the two powerful moderators for the sessions that we had, Omobolanle Adekoya and Niyi Adenubi. I thank you all so very much. We know because of the work that we do that executive time is very, very precious. So for you to have taken time out to be with us in this conference, we sincerely give you our profound thanks for doing that today and for enriching our audience with your wealth of wisdom, knowledge, and insight of Nigeria's capital market. And speaking to our guests, I really do hope that just like me, the conference today has provided you with some solid outlook and expectations for the coming year. I really hope that that benefits you in the investment that you make, and of course, in the choices and financial choices that you make. And of course, we have also taken note of some of the challenges and the difficulties relating to investment in Nigeria. I mean, you can't talk about investment in Nigeria without talking about exchange rate devaluation, inflation, interest rates, and choices and the decisions that you make. So let me also thank our sponsors. It's always very, very important to thank our sponsors. And the reason is very, very simple. Our sponsors, why we provide a platform, the ability for us to come to you this afternoon has been made possible because of our sponsors. So I'd like to thank all of them. We have the Nigerian Stock Exchange, the FBN Quest, VFD Group, Ancoria Asset Management, Alliance Law Firm, EFG Hermes, ST Health Trustees, Commercial Partners, and the last but not the least, CSCS. We thank you all for your contributions, and we thank you for the partnership, and we thank you for the sponsorship. We appreciate the contributions that you have made, and we really, really do hope that we can continue to build stronger partnership for a stronger capital market in Nigeria. Finally, I'll come back to you. You have been watching, and I hope you have benefited for the past 4 hours. So I really thank you for sharing your time with us here today. And we hope to see you in our future conferences and engagements with our readers and our subscribers. On that note, I'd like to say, please enjoy the rest of your business day afternoon. God bless you. Bye-bye.
We help them manage their affairs through the instruments of will or living trust. This helps them to also sustain their assets in the lineage even after they have passed on. This we do in form of estate planning. We also act as trustees to CIS, funds, mutual funds. Under mutual funds, we act as trustees to protect the interests of the unit holders. All forms of mutual funds, money market funds, fixed income funds, real estate funds, balance funds, name it, we act as trustees to all these funds, protecting the interests of the unit holders. Our major role is to ensure that issuers and managers of funds keep to the terms of their transactions. This helps us to get people to invest in our economy. Confidence of the investors will grow in the market and more funds. Without the capital market, our economy is going nowhere. And what we expect from the NSC, especially in this period, is to automate everything so that the practitioners will be able to render their reports seamlessly. Estate Trustees has been around for about 3 decades. The company was incorporated in 1991 and was licensed by the Securities and Exchange Commission to carry out the business of trusteeship and funds management. We act as trustees to the public trust, corporate trust, and private trust. Under public trust, we act as trustees to state bond issuances. As a date, we act as trustees to over 25 state bonds across the 6 geopolitical zones of the country. We also act as trustees to federal government-backed debt issuances, such as FGN Sukuk 1, 2, and 3. We have the Nigeria Mortgage Finance Company. We have local contractors receivable bonds, and a couple of FGN-backed debt issuances. In the area of corporate trust, we act as trustees to some corporate bonds and notes to ensure that the interests of the investors are well protected. In the area of private trust, we act as trustees to private individuals. We help them manage their affairs through the instruments of will or living trust. This helps them to also sustain their assets in the lineage even after they have passed on. This we do in form of estate planning. We also act as trustees to CIS, funds, mutual funds. Under mutual funds, we act as trustees to protect the interests of the unit holders. All forms of mutual funds, money market funds, fixed income funds, real estate funds, balance funds, name it, we act as trustees to all these funds, protecting the interests of the unit holders. Our major role